Matthew Herrick is the Sierra Pacific Wealth Management Managing Director for the San Francisco Bay Area. He is a 25-year veteran of the securities industry, a former corporate attorney, and a member in good standing of the State Bar of California, and a holder of the prestigious Chartered Financial Analyst, CFA designation. Mr. Herrick works closely with clients on comprehensive financial planning and investment management topics. Next is Walt Loomis, the Sierra Pacific Wealth Management Senior Vice President and Director of Business Development. He has provided financial advisors and clients with comprehensive wealth management solutions since his first day in the financial services industry in 1997. He brings nearly 25 years of expertise in investment portfolio design and management, retirement planning, and complex high net worth solutions. Walt holds the Series 7, 63, 65, 9, and 10 licenses. That's a lot of licenses. He graduated from the University of Wyoming with a BA in journalism and telecommunications. Next is Ben Sloves, a Sierra Pacific Wealth Management financial advisor. He graduated from the University of Nevada, Reno, with a BS in finance and economics. Ben joined the Sierra Pacific Group at Morgan Stanley in 2016 and served as one of the 4 financial advisors for the team. In his role at Sierra Pacific Wealth Management, Ben is primarily responsible for assisting with portfolio modeling and manager selection, investment model management, economic research, and synthesis of a vast amounts of research. And finally, last but not least, Conor Long, Regional Vice President at Columbia Threadneedle Investments. Long is a financial advisor with over 12 years of professional finance experience. Long maintains a Series 66 license, qualifying him as both a securities agent and an investment advisor representative in California and Nevada. He received his BA in business marketing from James Madison University in Harrisonburg, Virginia. And now we're going to switch over, and already Ben Sloves, you are now one of the co-hosts as well. So welcome to our speakers, and we're really looking forward to everything you have to share with us.
Okay, let's first just thank everybody for joining us today. This is a really interesting time in our lives, and especially as investors, professionally and personally. I met with everyone here in February of 2020. It was right before, if I recall, the pandemic shut us down. But I want to thank you guys for all the important work you do, educating the brightest minds in San Diego and really setting up the future for all of us. We appreciate what you do, and we know it's been challenging over the last 2 years. It's great to get back in front of you. I'm welcomed today by some of the best minds of Sierra Pacific Wealth Management. Walt, Matthew, Ben are working behind the scenes every day with Ryan. And this is a great opportunity to introduce them and become more familiar with the many people that contribute every day to making your retirement a success. My name's Conor. I'm based in San Diego, and I'm going to be walking you through the current outlook on capital markets, the economy, and the big question, are we headed for a recession? We hope you can walk away from today with great data, with research, with insight from an educational standpoint to make the best decision possible. And then we're going to end with our opinions, because at the end of the day, we want to share with you not just what we see, but what we think may happen in the future, which is actionable information as well. Let me kick it off with a little bit of a summary of what we've just gone through in the first quarter of 2022. What have we gone through? We've gone through a Ukrainian conflict with Russia, which has spilled out of their local border to a global conflict. We have rising inflation fears. We know it. We see it at the pump. We see it when we travel. We are no longer dealing with low cost. We're dealing with a much higher cost environment in our daily lives. And that has put pressure on the Fed. The central bank of the United States is now at a point where they must act, and they're changing policy. How aggressive will that change be? What does it mean for your portfolios? What does that mean for equities, which are currently under pressure? So giving this kind of backdrop, I want to highlight some outlook, what we expect to happen. We do think, number one, monetary and fiscal policies are expected to become less supportive. The central banks supporting assets and stepping in to provide relief if we encounter another pandemic is less likely. We've reached a point of excess, and now we need to be reducing support. Second, GDP is expected to come down and slow globally. We talk about the peace dividend. Now nations across the globe are spending more and more on defense. That means there's going to be likely less spent on important programs, and that peace dividend, which we've experienced for roughly 20 years, may diminish. Fixed income. You may not notice this, but the bond market had its worst quarter since 1980, roughly $11 trillion wiped out of the bond market. What does that mean for us? And lastly, equities. Currently, valuations are still above average, and we expect earnings, which provide return for stocks, to be high single digit in 2022, meaning there's opportunity for return. But if we have pressure on prices from higher rates, from global tensions, from inflation, where do we see the best opportunity? Now I'm going to pass it over to my good friend and partner, Matt, to give you an idea of what asset classes performed well and did not perform well in the first quarter. Thanks, Matt.
Thank you, Conor. Obviously, it was a difficult first quarter for investors, everyone. And before I get into that too much, again, thank you all for joining us. Thank you, Suzanne, for allowing us to pinch hit for Ryan today. If we take a look at slide 4, which is where we are right now, it was clearly a rough quarter for both stocks globally and for bonds. We've seen somewhat of an unprecedented outcome there. You don't usually see bond returns as negative as stock returns are. Oftentimes they are inversely correlated. But I do want to remind everyone that bond prices trade just like stock prices. They go up and down with the level of interest rates that prevail. And coming from a very low level of nominal interest rates at the beginning of the year, and certainly if we look back 2 years at the beginning of the pandemic, yields arguably had nowhere to go but up, and therefore bond prices had nowhere to go but down. And that impacts stock prices and in terms of the multiples and the valuations that they see, which is maybe a slide that we'll touch upon, Conor, a bit later in the proceeding. The one notable bright spot was commodities. We'll be talking about inflation during the course of the presentation, and as a diversifier, they certainly did do their work for us. And if investors had some exposure to commodities, it did help for a period of time. Although just in the past 3 or 4 days, we've seen some of the froth in that market sort of cool off a bit, and we'll have to see, where things go from there. But commodities are, broadly speaking, undervalued relative to stocks and bonds based on the return pattern that we've seen over the last decade or two. That is, I think, slide 4. Walt, did you want to jump in on slides 5 and 6 possibly?
Yeah, let me just go back to the commodities for a second, Matt. So I will say, obviously there's been great demand for those in a limited supply chain. However, with all that being said, our firm has gone from looking at the risk reward profile of commodities, has gone from a favorable rating to a neutral rating right now, just because of how quickly they've come up in price. And so it's not to say there's not good names out there you can buy. However, you just have to be really selective with those names.
Slide 5.
Yep.
We're on slide
So-
5 now. You're good.
Oh,
to go.
Yeah, so the interesting thing to me is like hardly anything got through unscathed in this market, and for all the reasons we just talked about in terms of high valuations amongst all the other geopolitical things and everything else. But if you look at the last 1, 3, and 5 year returns on growth, large cap growth, they have significantly outpaced large cap value during that period of time. And then all of a sudden this year it switched. So just in the first quarter, you saw large cap growth down 9% versus large cap value down 0.7%, which is a significant change, right? And so there's a number of reasons for that. And we're going to give you a strategy later on large cap value. But I would say that that's very important to look at. And our most favorable rating right now on asset classes is large cap growth stocks, including large cap growth and large cap equity. So value as well.
I think one of the this is Matthew Harry again. One of the things on the previous slide too, whether we can go back or not, or slide 5 rather, is to notice that in terms of smoothing out one's returns, which is what all of us want, especially as we get further into our working lives and approaching retirement. The balance between two styles, value and growth, that we see on the left part of the slide really does minimize volatility over time. Value stocks, certainly in Q1, you picked up some of the energy and fossil fuel names, which many investors have de-emphasized in recent years for a number of reasons, and that's perfectly acceptable. But value caught some of that trend. Energy complex did very well in the first quarter. Basic materials did very well in the first quarter. So a balance between the two, as you can see, or even an overweighting to value, did substantially outperform in the first quarter. And I think the smoother the returns, the easier the experience for investors, whether they're again mid-career, approaching retirement, or certainly in retirement. Sorry, Connor and Ben, did you want to just jump ahead to the previous slide 7? And just looking here, this is dated a bit now because asset prices have moved quite a bit since December 31st, 2021. But we have these return expectations, and when stock prices fall, like they have, broadly speaking, year to date, these going forward, these forecasted 5-year forward returns actually improve in terms of expectations. So one silver lining is that the more difficult capital markets conditions are in the short run, or let's just say in 2022 for that matter, the better the opportunity is on a go forward basis. So it's always important to sort of keep a level set when it comes to one's emotions and one's expectations, especially in the middle part of the category, which is the green bars, the lighter green bars for bonds. Those expected returns have come up quite a bit because yields have come up quite a bit. So the starting point for investors owning bonds at a 3% interest rate or 2.5% is a much different situation, obviously, than at 1 or 1.5, where we've been for a lot of the last 24 months, and even a good portion of the last 10 to 15 years. Connor, I'll throw back to you for the next set of slides, I believe.
Perfect. Great summary, Matt and Walt, on what we saw in the first quarter and what we can expect for the next 5 years. Let's pause for a moment. And if anyone does want to come off mute and volunteer and answer, that's always fun. I love hearing from you guys. It's been a long time. So I want to ask a question. What do you think the first or second biggest risk is right now for your portfolios, for investors? What comes to mind? What could be an event that would force your portfolio into a difficult position? Now, sometimes we get comments written in. Sometimes we get radio silence, but I think you're all thinking about two themes that's on everyone's mind. The first is recession itself. Major risk for a portfolio and for investors is buying at a time when the economy slows down. And we would define a recession as 2 consecutive negative quarters of GDP. Now, if you watch CNBC, God bless you if you do, it's a little difficult to get through it because it's green and red, and lately it's been more red. They may be talking about a leading indicator known as the yield curve. And the yield curve is often used by investors to predict or to lead a recession. Now, when it inverts, what does that mean? It means that the short end of the yield curve is higher than the long end. Now, what does this mean for us? If you have a yield curve inversion, it's a lot like saying, I saw a cloud this morning and I think it's going to rain. Now, if it doesn't rain that day, doesn't rain the next, doesn't rain that week, but it rains a few months later, were you right or wrong? Technically, you were right, but it doesn't give you much information to invest upon or plan your day. Similar with the yield curve. You can see that when the yield curve inverts, there's on average, looking back at every recession we've seen in the last 50 years, there's 19 months before the recession actually begins. If you look back at history, 2005 to 2008, there was a 35-month delay before we saw a recession. And there were major returns to be had in your portfolio during that time period. The shortest we've ever seen was actually in 2020, only 7 months from when the yield curve inverted in 2019. And then in March of 2020, a month after we got together, we had a recession. But we could argue, if we didn't have a pandemic and a lockdown of business, we may not have had that recession. So what's a more accurate predictor than this yield curve? Well, research would show, our good friends at the New York Fed, that looking at a 3-month T-bill and comparing that to a 10-year is more accurate. Now, what this tells us is that we're not seeing a true yield curve inversion. We actually have steepness, which tells us there's a very low probability of recession in the next 12 months. We'd assign that a 5% probability. But what Walt, Matt, Ben, Ryan, and I will all do is surveil this. If we do see this key metric of inversion happen, we'll position portfolios accordingly to become more defensive. But the main message here is it's too soon to call that single cloud in the sky worthy of a recession, worthy of imminent rain. We think that there's still much time to be had and much great opportunity for investors. I'm going to move forward and pass the stage over to my good friend Ben to talk about another big risk and another big theme for investors, which is inflation. Thanks, Ben.
Thanks, Connor. So we can't escape it. Inflation's everywhere. It's in the media. Everybody's talking about it. And let's go over some inflation expectations and what is sort of going on. Connor, if you can go to the next slide, slide 12, please.
Good to go.
So here we have core inflation and inflation expectations. So this graph or this chart shows US CPI, and CPI is the consumer price index. It is the measure of the change in the prices paid by consumers for a basket of goods and services. That includes food and beverage, housing, apparel, transportation, medical care, etc. And inflation has been elevated for several reasons. There's the base effect, which means let's look at inflation and backdate it to the last 3 decades or so. And the last three decades or so have been fairly low, so now we have a higher base. We also have supply chain disruptions, which we've never faced before. You've had the global economy shut down for months or weeks on end, and then try to flip it back as if it's a light switch. It's a very difficult thing to do. So you had supply chain disruptions, and then you have pent-up demand as well. I feel it myself. I've been excited to go back out there to travel, to eat. I'm sure some of you have as well. And there's just not enough supply out there to meet the demand. Now, let's add the unfortunate situation in the Ukraine that puts inflation pressures a lot more on Europe and overseas, but it still has an impact for us here in the US. The Ukraine exports about 25% of the world's grain and wheat. So those are some of the reasons why inflation has been elevated for so long. And if we look out forward, Both us here at Sierra Pacific Wealth Management and participants and market participants expect inflation to come back down. Conor, if we could go back to the slide, thanks. So yeah, inflation is expected to fall. We think inflation remains elevated for this year, but let's look, 1, 3, 5 years out, and inflation is hovering at around 2%, which is the norm. That's what the Federal Reserve wants to do. And the next question we have to ask ourselves is, how low will inflation fall? What parts of inflation will stick, and how will the Fed accommodate? How will the Fed respond to inflation going forward? And I think that is it for that. Let's go to slide 19.
19 is up, Ben.
Awesome. So one of my favorite sayings is, when in doubt, zoom out. This chart shows inflation going back before the Revolutionary War since 1750. And as you can see, inflation has averaged about 1.7%. And there's a pattern here. Inflation creeps up during times of war and economic expansion, and then falls when geopolitical tensions decrease and when the economy contracts. And that's exactly where we're going. So if you look at where we're at, we're above average, but compared to the long term, some other events in the history, it's kind of holding in. It's okay.
Thank you, Ben. And I think you could admit that perhaps we had a war with COVID 2 years ago, and there's a fear of war right now. So perhaps that moderates and the position improves. We're going to pass things over to Matt, and zooming out even further from inflation, looking at the global markets and opportunities within.
Hey, Conor, can you jump to 24? I actually think it's a little less noisy and helpful for everyone. I don't know how many of you follow Warren Buffett in the audience. He has his annual meeting this Saturday in Omaha. A value investor, and stepping back to kind of look at the different equity valuations around the world. U.S. stocks as a multiple to earnings clearly trade a premium to the rest of the world. That is probably justified. We have a lot more technology companies. We have a lot more companies that are growing revenue and sales, but we're still about 25% overvalued relative to a historical average. So call it 20 times earnings relative to a historical average of 16. Emerging markets, which include sort of everything but the US and Europe and Japan, broadly speaking, are trading not only at lower valuations, nominally speaking, but lower valuations relative to their historical averages. Europe is trading about the same in terms of its historical average. We would expect the US to continue to trade at a premium, but what this does show us here is that globally allocated stock portfolios have probably a greater margin of safety in terms of valuation than do solely US and certainly solely US growth portfolios. And given that we've had such a decade of outperformance for US large cap growth stocks, think Apple, think Google, think Tesla, Facebook until recently, stocks like that, most investors are probably a little bit more over allocated to US and US growth stocks than they might historically be. If you look at a pension fund like CalPERS, they're really stepping back and trying to, again, smooth out returns and looking at different opportunities like this across the globe in terms of stocks and then relative to fixed income. Maybe the next slide, Conor, would be helpful at least to take a look at. One point I wanted to make here is simply that the lower the bond yield as we're moving from left to right, the higher the price to earnings level for stocks. And so we are moving from the upper right down toward the lower left. We're a long way from the left end of the scale, but we're a lot closer to the midpoint of the scale with 10-year treasuries between 2.5% and 3% than we were, let's say, 24 months ago, when we were much more in the upper right end of the scale. And so to some extent, the movement up in interest rates, the movement down in stock prices year to date is quite healthy. It gets us much closer to an equilibrium level where much more froth is out of the market, high excess valuation is out of the market, and we can sort of level set from here. Want to go to slide 26, Connor, real quick, and then I'll get back to. And this is kind of a noisy slide as well, but what we're basically talking about here on the lower half is the relationship to earnings and 10-year bond yields. And stocks have become a lot less overvalued relative to bonds over the last year and a half. You can see we've gone from that white region about 18 months ago, call it, where stocks were overvalued according to this long-term midpoint, to probably more fairly valued. Now we might overshoot as stock prices do. You can see, 10 years ago, stocks were undervalued relative to bonds, but we're back at a point where I think there's a lot more normalcy to where we're at. And I think we're ready for slide 27. And possibly throwing it back to Ben on this one.
Growth versus value. So this is kind of adding to what we've all been saying. So growth stocks have been hit really, really hard, especially this year. Main reason for the rise in interest rates. Growth stocks are stocks that are, they don't have a dividend, they don't earn any money, and all of their pricing and valuation is on future cash flows that are generated from their business. So when interest rates go up, the cost of doing business for them and the cost of financing becomes more expensive. And when you look at the valuations, their future cash flows are now worth less. So you've had a ton of rotation out of growth stocks and into value, as you saw earlier in the slides, with large cap value being down 0.7% for the year versus growth being down about 10 to 15%, depending on which asset class. But if we look at this chart here, which is the forward PE, so forward earnings expectations, currently growth's trading at 75%, which is about 100% above the historic average, which is 37%. And we have a lot of clients asking us, is this like 2000 to 2002, the tech bubble? And I wouldn't, as you can see, the tech bubble, the forward PE was 160, and we've come down quite a lot. The valuations are still high, but nothing like 2000 to 2002. So, and because of this, because we're in a rising rate environment, we have put an overweight on value in the portfolio in both small caps, mid caps, and large caps.
Wonderful. Thank you for sharing that, Ben. So stylistically, leaning towards value makes sense at times like this, but not abandoning growth completely. Walt, I'd love to hear your thoughts on what we think about the developing world. We talk a lot about Ukraine and China. What opportunities and opinions can you share about investing outside the US in the emerging world?
Well, thanks, Connor. I appreciate it. But, one of the things I get asked all the time is, we see this geopolitical risk with Russia being in Ukraine. What happens if China goes and invades Taiwan? And so from one man's perspective, I can just tell you that from everything I've read and everything I've heard, they were actively looking to do that before Russia invaded Ukraine. Well, what they didn't expect was the global response from a sanction standpoint, right? Of folks that weren't even in NATO or weren't even economically impacted by that invasion, that they were all putting sanctions on Russia too. Russia can probably survive those sanctions. China will have a much harder time doing so. And the reason why is they're major importers of their food and major importers of their energy, right? And so if China was hit with sanctions that Russia was hit with, they're going to have a major issue with potential mass starvation, potential rolling blackouts immediately. And so I think that really scares Xi Jinping and as well as the rest of the party. And if they go ahead and do that, even with those things, they're going to really alienate a base that's already significantly alienated from the COVID lockdown. So I think the likelihood of that happening in the near future is not very high. Now, somewhere down the road, possibly, but so I would say that we're still dealing with a major geopolitical issue with Russia, Ukraine. But I think there are some emerging markets you can play. But again, it's one of those quality things over just trying to scatter shot something. So you really have to take individual names that you feel confident, that have good supply chains, that have good growth prospects and the like.
Wonderful. Yeah, so the punishment of Putin may discourage future violence and escalation in China, which is actually good news, right?
Right. Hopefully.
Thank you for sharing that.
Sure.
I'm going to toggle over to a lesson that we discussed in our meeting pre-COVID, really about opportunity within value. And that's really just a concept which is simple. It's very Buffett born. It's about investing in what you know and understand. And that's often dividends. If you look at the long-term history of stocks and you want to look at what doesn't work, what works, and what works the best, you can simply look at dividend policy. Over a nearly 60-year time frame, you can see that stocks that don't pay a dividend tend to underperform in the light blue. Those that are in the S&P 500, just the aggregate index, are in gray. But those that have a dividend and grow it over time tend to outperform. And this also makes sense today. If you look at why we would invest in stocks, even with all these clouds on the horizon, these risks we discussed, high quality companies that are consistently growing their earnings and then returning the earnings to shareholders in the form of a dividend do very well when we have inflation. Because companies can raise prices and pass them on to consumers, we want to own those companies. Where in bonds, you typically can't see that coupon adjust higher if inflation moves higher. So historically speaking, it's always great to own dividend growth stocks, but especially when you see inflation increase, they outperform. It worked in the 70s, it worked last year, and if you have low conviction in all things, it's always a good time to have conviction in dividend growth stocks. And you guys own quite a bit within your investment Sierra pack. I'm going to pass things over to Matt to round out a strong opinion on fixed income.
I think we're jumping, Conor, to is it slide 42?
We're there. Perfect.
Right. So this is unfortunately a noisy slide again, but if we go down the column on the left and we have a 10-year starting yield now of somewhere between 2.5 and 3. As interest rates rise from here, let's say we get another 1% increase in interest rates from here. Bond prices are going to fall a little bit, 3.7%, but nowhere near as much as they fell from the move from 1 to 2%, or certainly from 0.5%, et cetera. And that is simply a function of the fact that bond prices have come down to correlate for higher interest rates. Your starting coupon at, let's say, 3% provides you with quite a bit more cushion. And if you'll notice, as we go down the column on the left as well, as interest rates go up, if they do from here, the impact of an increase in interest rates is even less than it is at this starting point. And I think as we get into our careers, mid careers, later part of our working careers, or our retirement years, as we look for dividend income growth, we also look for interest in coupons. It's something to look forward to. If we do see higher yields for retirees, savers will get paid more on their savings.
You just locked up.
We've got a Matt's been frozen in time. I think that's what happens when you think about the bond market. All right, you're back.
Yep. Sorry, I don't know how long I was gone. Apologize. But just talking about the bond market and the interest that's available now versus a couple of years ago, much more attractive, kind of playing with that same theme as dividend growers and earning income for your stocks. you've now got an opportunity to earn more income from your bonds. Back to you, Conor.
Love that. So it's counterintuitive. If bond prices go down and yields go up, it becomes a buying opportunity. And that's what we're in right now. Similar, if you have stock prices go down 30%, it's actually it's a buying opportunity. You want to buy what's on sale. And the recent sell-off in bonds has created one of those. So counterintuitive, but a great thing to note. Bonds are now attractive again. I'm going to close this out.
Sorry, Conor, to add to that, one of my favorite things is in the financial industry, or just, you know, asset management, what have you. This is one of the few industries when things go on sale, people don't flock to buy. You know, if you go to Best Buy and you see your favorite TV drop 20%, you're going to rush there immediately. It's different in stocks and bonds. It's interesting from the psychology standpoint.
I agree with you completely. What a strange paradox we work and live in. They say the market's rational, but we often find that to not be true. So just giving you guys a summary of everything we discussed. We went through the data, the research, the views about the big question, you know, are we headed into a recession? What's the guide for the next 2 years for investors? We considered inflation and the impact that has on the central bank and prevailing interest rates. A big question we ask is, can the Fed pull this off? Can they engineer a soft landing? You know, getting us out of emergency times with record low interest rates to reaching a more normal level. They've done this before. You can look at 2004 through 2008. They've failed if you look at 1994. We tend to feel that the Fed has enough policy and tools to achieve a relatively smooth landing. But one reason we're here for you is to make this landing as smooth as possible. We're here operating like NASCAR support crew to make sure that you have no pop tires and you can get to your retirement destination without any surprises or changes. As we look at the US and the global equity market, we're cognizant of valuations. You know, we expect returns to be lower than what we've seen in the last 5 to 10 years. So the bad news is you don't expect another 20% annual return in perpetuity, but the good news is these returns are still strong, net of inflation, and still attractive enough to get us to our retirement goals on time. And then finally, Matt closed out with fixed income. The devastation, the disruption, the challenge in the fixed income market in the rear view creates more opportunity in our windshields and moving forward. With better yields globally, we have opportunity to invest for income needs better than we've seen in roughly 4 years, which is great news. But what's on all of our minds? What's going to happen in Russia and in China, in the emerging world? And can we maintain a peace policy that's lasting? We will revisit this. We will be back again within another quarter, and we'll continue to add content to your virtual wall, which Suzanne pointed out. And at this time, we're going to stop because we've done a ton of talking. Are there any questions anyone has that's personal to their portfolio, general to the market, or we can follow up with you individually and privately if that's preferred? Any questions now?
Well, thank you, Conor, and all of you on the panel. This was a lot of information to digest. Very, very intense for those of us that are not specifically financial managers. But I want to throw it open to members. Are there any questions from our members? Feel free to either raise your hand electronically or just go ahead and speak up. But it sounds like you're saying we're looking at inflation really calming over the next year. We're not going to be seeing these off the wall numbers of 6.5%, 7% that we experienced this last year. And that's really good news.
Yes, we would agree. And we apologize if we made it too technical. There's a reason why Ryan keeps us in the kitchen, so to speak. We're the sous chefs, and he likes to present things in his own way.
Well, that's one of the helpful things about having it recorded. Those of us that are a little bit geeky, we can go back and watch it again. And sometimes on second time around, it digests a little better. Question from Ron Campnell. Go ahead, Ron.
Yeah, how might improvements in the supply chain affect inflation? And, it seems like that's a factor that there's so much pent up demand that it's driving up prices like cars. We hear these stories. I've been car shopping and, people are, the dealers are, because of the lack of supply, they're and another example is increased value of used cars. But as the supply chain hopefully improves, how might that impact inflation and reduce the pressure on the demand side?
Hi, Ron, this is Matthew. I think that dovetails on what Suzanne just said, and it should help. Supply chain improvements should help inflationary pressures moderate in the next 6 to 12 months. I do think most of us would agree the pandemic is, while not in the rearview mirror entirely by any stretch, it's increasingly so. We have seen used car prices moderate substantially in recent months. And as goods become increasingly available, the supply of them, et cetera, we would expect inflationary pressures on many of the things that we buy to ease. Having said that, we're not out of the woods. China is in the midst of lockdowns as we speak, and there are supply chain issues coming out of the world's factory floor, which is China. And the offset of that, I guess, Ron, too, is we're seeing supply chains be relocated around the globe, and we're probably going to have more manufacturing and more jobs domestically, as are other countries, and that actually may be inflationary, more inflationary than the globalization trend has been over the last several decades. So without a recession, we don't see inflation going back to the 1.5% levels that we saw for a lot of the last decade. But certainly the numbers we've seen the last 12 months are very elevated.
What percentage of the inflationary factors approximately would you say, we've talked about cars, but also housing. In the United States, we hear that, housing and cars are such a huge factor in the economy. Could you talk a little bit about housing, impact of housing on inflation? Thank you.
I think housing is one of those elements in the CPI basket that we're looking here that's broadly underrepresented in government statistics. We live in California. Obviously, housing inflation has been running at very high levels for some time, and it's a real problem here in California. But across the country, it's less so, coming off of a much lower base of inflation. But with the population growth we need and housing starts still below prior peaks, I would expect there to be at least a moderate inflation in that sector, if you will, going forward. But broadly speaking, nothing like what we deal with in California or have.
Yeah, no, and I'll add to that too, Matt. And the most recent data that I saw, and this has to do with housing as well, but it's more on the rental side. And so you're seeing such an inflationary pressure off the rental side that it is counting for nearly 30% of the consumer price index right now. So it's a real thing, and hopefully we can get a handle on it.
Have you gentlemen gamed out, in looking at the Ukraine-Russia issue, Europe is talking about potentially adding the sanction of shutting off their gas lines with Russia, which would have a huge impact on Europe, and I'm sure would then boomerang on our economy. Have you all looked at, what that impact would look like?
Sure. So I would say that they're going to do it piecemeal for right now. I'd say the chance of a recession in Europe later this year is much higher than here in the United States, simply because they're getting all their supply directly from energy supply directly from Russia. And so, but they can't do it all at once. It would just absolutely destroy the economy. I agree with you. And so I think they'll do it piecemeal and try to find a solution. And then hopefully the OPEC producing countries will agree to start producing more oil.
Okay. Barbara
But yeah,
Brody.
but you're right, Barbara, it'll eventually come over to our, trickle down to our economy as well.
Right. Barbara Brody, question, go ahead.
Yes. Thank you, Suzanne. And thank you, panel, for this really wonderful presentation. I've been a big supporter of growth stocks, but I love to buy things on sale. So I'm interested in the bond market. And I'm wondering if you could discuss whether any of the bonds that are attractive are also tax-free, not wanting to add necessarily to taxable income. What are your thoughts on that?
Hey, Connor, we have a slide on munis, don't we?
Yeah, we do. Great question. Great. I really appreciate you asking this question on fixed income. We're going to start off with this one. Matt, do you want to begin and then I can help kind of carve around the visuals?
Sure. We certainly are, Barbara, in the largest municipal bond, also known as the tax-free muni bond market in really the world in California. And municipal bond yields have risen along with the rest of the fixed income landscape. Mm-hmm. So you do have the opportunity, just like you do in treasuries or corporates, to look at municipal bonds as a source of more income than would have been available, let's say 6 months or 12 months or certainly 24 months ago. That's, I think, a fairly simple answer.
And if you don't mind, I'll add to that. So the muni market is what funds our local roads, hospitals, schools, in many cases, a lot of public projects. Close to 43 states have now announced they're in a budget surplus. The states have done far better than anyone expected emerging from COVID, and even Illinois with Detroit, Illinois with one of the worst records recently received an upgrade. We think that the muni market offers one of the best fixed income opportunities, because if you look at what you receive in California, tax equivalent yield, meaning if I were to look at the equity market, what would I need to get to equate to my muni return, is roughly 7.5%. You now, for the first time in 5 years, have bonds below par, trading cheaper than what you would initially get them for, with yields that are the magic 3.5% to 4% number. So right now, owning muni bonds makes more sense than it has in the last 3 years, because rates have increased so much, and the tax efficiency of the rate of return makes them very compelling relative to other opportunities out there. If equities are going to give us perhaps 8%, earning a tax equivalent yield of 7.5% in a lower risk muni becomes very attractive.
Great. That's a wonderful and helpful answer. Thank you.
Yeah.
Other questions from our members? Barbara, your hand's up again. Go ahead.
Oh, I'm sorry. I'm not very adept at all of this. I meant to lower it. Thank you.
Thanks, Barbara.
Thank you.
No worries. Glad that you jumped in. Any other questions from anyone else? Here's your chance. It's not every day we get such a wonderful panel.
Well, if there are no questions, I ask if you can think of something that's really personal or very compelling and important in your life, email it to Suzanne, and then we'll make sure that Ryan and his team follows up with you individually. We love the discussion. We love the opportunity to share our best ideas and research, and we really appreciate the time today. So we wish you a great week and look forward to our next opportunity together.
Well, our thanks to you, Conor, and to Ben, Walt, and Matthew. Really appreciate all of the knowledge and experience that you brought to bear on this topic. It was very enlightening. Thanks so much. Take care.
Thanks for the opportunity.
Thank you.
Bye-bye.